Very nice to be back with you again. As I mentioned in the previous short form video that I send out without any special guests, like our conversation with Austin Fitch of Horizon Investments today, I am always glad to send these to you and welcome your feedback every time that I do send them. Today we have a good discussion planned with Austin. We're going to keep it just under 20 minutes for you, but really jam-pack it with a lot of great information. Starting with our guest, of course, he's been with us before, which we always appreciate him and his input. Austin Fitch, the head of consulting solutions at Horizon Investments. He is a chartered financial analyst. He joins us again to talk the third rail, politics. We're going to get into that today. Talk a little bit about the Federal Reserve running the stock market these days and even the bond market to a degree. The impact each of the different talking heads have on the stock market or have had and what we think they could, and give you positioning on portfolios heading to the end of 2024 and into 2025. Austin, welcome. Always great to have you here. Thank you so much for joining us.
Absolutely. Thanks for having me, Lou. Excited for the conversation.
Yeah, pleasure. So before we get started, I just you're looking at the disclosure. I really shouldn't talk over the disclosure. I should let everybody read and just enjoy the words on the screen. But I do have to throw in a let's go Mets. We are day one of the Major League Baseball playoffs. I have been a New York Met fan since 1973. You can look this up. Willie Mays stole one base for the New York Mets in 1973. And I just happened to walk into my family room. My dad was watching the Mets. I said, "Hey, Dad, what are you doing?" He said, "I'm watching the Mets." Willie Mays steals second base. I said, "Well, who are they?" He said, "They're my favorite baseball team." And I said, "Well, they're my favorite baseball team." So since 1973, I have been a tortured soul with New York Mets baseball. One World's Championship in there, several near misses. And all I can say is, why couldn't he have been watching the Yankees when I walked into the game, that room? So anyway, let's get to it. Austin, plenty of good things to talk about. Thanks for putting the disclosure up as it applies to compliance. Everyone will love that. Let's get started with one of my favorite topics right now, personally, which is trying to figure out why the Federal Reserve have become like rock stars to the stock market. Okay, this is entirely frustrating as somebody who's been at this a while now. When I first started, there was a literally like a message that would come through, and by the way, it wasn't an email even. Right. In 1992, it was the stock market would report. You'd have to watch the news, and it would say Fed leaves rates alone. Fed raises rates, Fed lowers rates, and no one batted an eye. Yep. Well, fast forward 30 plus years later, and it is like, we're having Fed watching parties at this point where, and it's, it's not just Mr. and Mrs. Investor at home. Oh, yeah. It's Wall Street. It's like everybody's popping their popcorn and getting ready with drinks for Jerome Powell to speak. How did we get here? Is it healthy? Is it going to continue?
I think those are all very fair questions, and I'll maybe take them a little bit out of order. Is it healthy? Probably not. Is it reality? Absolutely. And is it going to continue? Yes. Unfortunately, fortunately, however you want to look at it. To kind of your point, 20, 30, 40 years ago, the Fed was, I won't say an afterthought, but definitely not prime time watching material, right? Today, and in reality, you could make the case probably post 2008, their impact on the market is nothing short of kind of massive.
It's a real impact.
Right, yes, 100%. And what you're experiencing or what we're seeing is the fact that, at the end of the day, the world that we live in right now, the Fed can, and in a lot of cases has acted as a backstop in the event that things start to get, out of control, right? We saw that in 2008. We saw that in 2020 in terms of, their willingness to, participate in market activity to some extent. So yes, and that's partially in reality why it is relevant is because their willingness to somewhat engage in markets, right? And I think they understand that, right? And to your point about being rock stars, I'm not going to sit here and speculate on their desire to be famous as a Fed governor, but they are, whether they want to or not, right? And that's just reality. Now, we've had this debate internally. What we just lived through, and I think we've made this comparison in previous conversations, it is a lot like when the U.S. went through World War II, is very similar to when the U.S. and for that matter, the global economy went through COVID. I mean, in essence, we were fighting a war, and then we've just lived through kind of a post-war recovery. The irony there is, and Lou, you may or may not even know this. Do you know what the Fed did coming out of World War II when inflation spiked and things were getting a little crazy? Do you know what the Fed did during that scenario?
I'm going to give you a guess that they raised rates.
They actually did nothing. The Fed did nothing for 3, 4, 5 years. And do you know what happened with inflation? It came back down.
Yeah, it took care of itself. Yeah,
right.
The markets corrected it's themselves. Yes.
Yes. So you could make the case, and again, I'm not sitting here saying that the Fed's not important and doesn't. They absolutely have relevance to some extent with their dual mandate. But you could make the case that everything we just lived through and what the market has made such a big deal about, and to some extent, the Fed, props themselves up. You can make the case that it really didn't need to happen, and probably, like to your point, the market would have corrected itself. So it's a really interesting dynamic that we live in. But like we said, it is reality, so we got to deal with it.
All right, it's a noisy time. I mean, you have Jerome Powell, who is the chairman, comes out and delivers the official talk. Yep. And then over here, someone comes out and says, oh, no, I was the dissenting vote. And it's just like, what the heck is going on? Yep. Really, the Fed should be heard, never seen. Yep. That is my thought about the whole thing from a professional standpoint. Obviously, 24-hour news cycle, we can't get away from it. So now the reality of it is they've lowered rates. They went 50 basis points. Fine. I don't know that it makes such a difference, other than to say we think there could be some slowing down here. This will be a nice help to some of that slowing down from an economic activity standpoint. Does the investment committee at Horizon, the action committee, if we'll call them, see additional rate cuts in 2024? And please share with us a rate change impact on both stocks and bonds, please.
Yeah, no, I think we absolutely see further activity. I mean, I think you can make the case that the move that we had just this past month was really the starting point for what they will likely do over the next, call it 12 to 15 or 18 months. And what they're going to do is bring the Fed funds rate. So think of it as kind of the baseline rate for the economy. They're going to bring that back down to what they call their long-term neutral rate, or kind of between 3 and 3.5%, right? So they probably have anywhere in the ballpark of 8 to 10 more 25 basis point cuts. Now, I think it's somewhat dependent on some of that weakening or slowing of the economy that you talked about. Now, hear me say this: the economy is not weak by any stretch of the imagination. It's just slowing down from what we saw, where it was going gangbusters in COVID, right? So you've got this slowing of the economy, and the fact that they're going to be cutting rates is actually, to your point, going to be a bit of a tailwind, and hopefully kind of stem some of that tide with some of that slowing. And reality, again, we talk about a slowing economy. What you're seeing is just a normalizing economy, right? We were running too hot. We had inflation problems. We had a lot of things that we were fighting against. And in essence, that was why the Fed hiked rates to begin with. They were trying to slow that down and keep us from overheating. Now they're trying to make sure that we don't kind of fall into a recession with some of the rate cuts, and so that the interest rate environment isn't prohibitive to economic growth. So I think what you'll see is probably 25 basis points on average, almost every meeting for the next, call it year and a half. Yes, can they move faster if they need to, right? We've talked and debated internally, do they hike 50 basis points again this year? Maybe. I think that's going to be data dependent, right? Do you see some of that data show that it's weakening faster than you otherwise would expect? If you don't see that, then again, I think their default position is 25 basis points or 0.25%, basically every time they meet until they get back to that kind of long-term neutral rate that they want to be at, which, like I said, is somewhere between 3 and 3.5%.
Okay, and I apologize. I was moving around just a little bit here. I'm taking notes. I'm moving my notes from the right to the left so that that I can make sure that I ask the questions, and I'm taking notes so that I can follow up with some of the questions that just come into mind.
Yeah.
When you're talking about all of this, which is, I just think it's very, very interesting putting the pieces together.
Yep.
And I want to comment on, call it a normalizing economy. I have read more than once from more than one person that I respect, we've not had a normalized economy since 2005.
Yeah.
That because of the 2008 market meltdown and the easing of interest rates,
Yep.
and the significant easing of interest rates, that we actually haven't had a real economy for approaching 2 decades. And we're starting to see, now that we think COVID is through, through and we'll say gone. It's obviously not gone. I get my advertisements for vaccines and everything all the time, but and by the way, that's neither a non-vax or vax. All right. But a normalized economy is approaching us.
Yeah.
And that means the Fed raises or lowers interest rates. They try to find a correct interest rate level based on projections. And these are all projections. Okay. There are no, you could throw another pandemic, throw war, throw economic meltdown unseen. That's why they call them black swans. We don't know they're there. So throw all that in. And yeah, it throws all of this into chaos. But looking at things as they are now and what they typically over time, history, equate to are normalized ups and downs of an economy, of savings, of investing. So approaching that now with the Fed and then we'll wrap it up on the Fed and get to politics because that's even more fun. Approaching that now, you're seeing a normalized economy. Do you feel at Horizon confident in the next, say, 24 months and shorter because of the normalizing of the economy and the finding of a correct interest rate by the Fed?
Yeah, I think we actually do feel pretty confident, pretty optimistic with the outlook that we have here. And a lot of that, again, is going to be dependent on what we're seeing from a data standpoint. And Lou, I would highlight for folks that are listening, you're probably watching the nightly news. You're probably listening to, like you mentioned earlier, talking heads across the board. And maybe it feels like things aren't great. But a lot of that has to do more with kind of what they call rate of change. Like things over the last 2 or 3 years have gotten worse. Absolutely. But in absolute levels, to your point about kind of a normalized economy, if you actually look at where the consumer is, if you actually look at where businesses are, we're actually in a really healthy spot, right? Consumers in aggregate have a lot of cash and liquidity on the sidelines. So there is dry powder that can and likely will be put to work. If you look at, debt service ratios, credit usage, again, it's gotten a little worse over the last couple of years, but it kind of had to, given where we started coming out of COVID. So you actually have this environment where folks are actually, from a personal balance sheet, pretty healthy. Corporations are making money kind of hand over fist. And again, you've got this Fed that's now kind of a tailwind at the back of this really pretty strong underlying economy. We think that bodes pretty well for the next, to your point, 12, 18, 24 months. Now, that's not to say that, some exogenous black swan event can't pop up and send us off the rails a little bit. Absolutely, that can happen, but that's not in the crystal ball that any of us have. So I think given what we know today, we actually feel pretty good about the outlook over the next little bit.
All right. And thank you for all of that. And thank you for putting up with me while I move things around as we're talking.
You're good.
And for those watching, I apologize. I try to keep it right in the center, do my best nightly news at 5, 7:30 and 11. Okay. But sometimes things are going on over here that I've got to get organized. All right. Presidential election. Of course, the conversation has been and we've had it on video for everyone to watch and take that information, which is presidential elections generally don't have an impact on returns in the market. And if they do have an impact, and I'll go with the numbers, you correct them if I don't have them correct in my mind at this point, but 80% of the time there's a year of presidential election, the stock market is positive for the year.
Yep.
It may not be as positive as it normally is, meaning, and these are example return numbers only, if it normally returns 7% in a year on average, the year of a presidential election, it may be 5.5%. There's some impact, but generally, or from a numbers standpoint, statistical standpoint, the stock market is positive during a presidential election year. And we talked about the theory of not wanting to, neither candidate wanting to tank the economy
right.
as they become the presidential or the president or are the presidential hopeful while giving talks. But now we're down to brass tacks. Okay, we're within 45 days of the presidential election. It's even a little less than that at this point. But presidential election impact now for the next, until we get there. Okay, we're recording on October 1st. So let's say we're 35 days, almost exactly from the presidential election. So with that said, what kind of impact do the next 35 days have on the market in your opinion? And you don't have to give predictions of downturns or anything. Just what impact does it have, please?
Yeah, I think the biggest thing over the next month and a couple of days at this point is just going to be a heightened sense of volatility. And in reality, that's what you see really across the entire year, but you definitely see it in the month or two leading up to the election itself. Is, again, candidates will come out and say one thing or the other that's going to move markets because markets didn't expect it, right? The uncertainty, I know that we've talked about time and time again, markets don't like. And that's what tends to come to the forefront during an election cycle is some spending plan or some tax cut or some tax hike that is going to be put into place or supposedly put into place if one candidate or the other gets into office. And those types of, I call them bombshells, but in reality, right, they're just surprises for the economy. And you may see a jump one day and a reversion the next day, right? And that's the volatility that we're talking about that, tends to happen closer to the election. Because again, those types of things from a political standpoint drive people to the polls, right? Drive people to vote for one side or the other. So that the candidates themselves, whether it's, going to happen or not, oftentimes are saying things in the month leading up to the election that are trying to get people on their side, right? That's kind of their job to some extent when it comes to winning an election.
Politics, yes.
Right. And that's what you see. And again, markets don't like that, those surprises. So for the next month and a couple of days, you'll probably see more of that. You'll probably see more swings in the market than you would otherwise expect. But to your earlier point, total return expectations don't really change over the longer term for sure. But even over the shorter term, it's not like we would expect the bottom to fall out or to see the market scream and go up. It's just you expect it to be a little choppy and a little bit more volatile than it otherwise normally would.
Because of that uncertainty and it really isn't uncertainty, Democrat, Republican.
No.
That's not, it's just the change. Yep. That's it. It's not the person. Yep. It's the change.
It could come from either side of the aisle. 100%.
Correct. Okay. So with that, let's talk positioning. And we didn't touch on bonds during the interest rate part of our discussion. So let's talk about positioning now. and add bonds into that, please, to wrap this up.
Yep.
So stock market positioning, we've had conversations. Horizon send me plenty of information. We have offline conversations about this. You are positioned in U.S. based stock primarily at this point. So with that, where in the U.S. Stock market are you positioned at Horizon currently? What would you project? Of course, for compliance purposes and for the purpose of you do have the right to change your mind. That's what we want out of Horizon is no, we see it this way now. We want to make this change. So positioning moving forward, where do you suspect in the stock market, and how do bonds and give us the range of bonds that you're investing in? Meaning, are you very long on bonds? Are you mid, or are you still staying short on those?
Yeah,
please.
Absolutely. No, from an equity perspective, really maintain a little bit of that growth tilt. We do think there's a premium being put on kind of companies that generate, and are able to grow earnings, right? And I think that's something that as we get back into this kind of quote unquote normalized economy, something that will continue to be rewarded. But we do that in a way that we're really looking for kind of what we would call quality growth. So companies that have consistency, companies that have strong underlying balance sheets and fundamentals. We're not buying necessarily the super risky, growth companies that aren't actually making any money. We want to buy the companies that are making money, but actually, growing those earnings as well, which to some extent, maybe what you used to think. So a lot of times you think, companies, ultra high net, growth companies are going to be, internet type stocks of the late 90s. In reality, some of the companies that are the high flyers today, the NVIDIAs of the world, actually are growing their earnings faster than anybody else. So you could make the argument that some of those types of names actually that have been bid up and have seen those runs, to some extent, there's some reason to that because they're growing earnings at that fast pace. That being said, I will tell you expectationally, as we look out into 2025, we would expect a broadening out of the equity market. What I mean by that is, and I know we've talked about this in the past, the leaders of the market over the last year, 18 months, maybe even 2 years, everybody's heard the term the Magnificent Seven or the really high end kind of tech stocks that have led the way through this AI boom that we've seen. We think that starts to broaden out to the rest of the economy. We think companies further down the market cap spectrum, so smaller companies, maybe even mid-sized companies, start to see some benefit over the next year. We're not there today, but that's absolutely something that we're looking at as we look forward from an opportunity set standpoint. So quality, growth, and a broadening out probably are the themes that we're looking at on the equity side. If you talk about fixed income, we're really staying kind of middle of the curve. So we're not trying to get overly aggressive on long duration bonds. We're not necessarily staying at the short end of the curve. The short end of the curve, as we've talked about in the past, is definitely a place to be when rates are going up. The long end of the curve can be a place to be when rates are going down, but really only if that kind of rate cut is surprising the market. Our view there is that we all know that rates are coming down. That's really been priced into the market. So you're not going to get this massive bump from holding 30-year bonds that maybe you otherwise would have expected if the Fed had cut rates in a surprising fashion. Now, yes, the 30-year bond, if we go into a recession and the Fed cuts rates by 2 percentage points, yes, the 30-year bond will do great. It'll outpace probably, for that matter, everything else in the market. We don't see that in the cards necessarily anytime soon. Our view there is let's stay kind of middle of the curve, but let's be willing to take a little bit more what's called credit risk. So, right, you're buying companies as opposed to treasuries. So you're buying corporate bonds. You're buying bonds that maybe have slightly higher yields because they're being paid by companies, not necessarily by sovereign entities or governments. So we see a little bit more opportunity there. Again, along the same lines, buying higher yielding bonds in certain places where we think there's opportunity. Again, doing so in a way where we want to buy the quality as opposed to the junk. But those are really kind of, you think about both sides of the asset allocation spectrum, that's kind of how we're thinking about things.
All right. And I have to do this because I think it's important to explain. Sometimes we get into like financial advisor, chartered financial analyst territory. So I want to step back and we'll wrap it up here. But
Yeah.
I want to step back and say why bond, you use the 30-year as an example.
Yep.
Why it would go up in value, outpace even stocks.
Yeah.
Because I'll give this explanation, and please, I accept all coaching through this just to be sure that I get it exactly right for everyone.
Yep.
So if you use a tranche of bonds, so let's say a 1-year tranche of bonds, and that 1 year is 2022. When bonds were being issued, a 30-year bond with, say, a 5.5% interest rate on it,
Yep.
And you were buying that at $100. Well, now move over to 2025, we'll make it,
Yep.
and the same 30-year bond is being issued. New issues of the 30-year bond are coming out, and the interest rate is 4.5% that they're getting paid, and it costs you $100 per to buy those.
Yep.
The bond that you bought in 2023 has a 5.5%. The 2025 has a 4.5%. That's a huge value for the 2023. And the price of that goes from $100 to, let's say, $110.
Yep.
So that gets factored into your return. You can actually make money by selling that bond, not only on the principal that you paid for the bond, but of course the interest rate you've already been paid. So that's why the bond performance could suddenly go up. But again, I like the point very much that that's a surprise cut from Fed. So if suddenly Jerome Powell in rock star fashion came out and said, we're cutting by 1%,
right,
we're going 100 basis points.
Yep.
Well, then you'd have a bond party kind of thing.
Yep.
That would be a shock to the system in the other way. And it would lead to a lot of other discussions that we'll get to in 2025.
Yep.
That would be probably not so good. So, all right. Really well done, as always, Austin. We appreciate your time. He's Austin Fitch, chartered financial analyst, Horizon Investments. Always appreciate the time. And I'll say this, I don't think we'll do it again before the end of 2024. We will wait with our popcorn second Tuesday in November, and possibly a lot longer than that.
There you go.
Based on everything I read about who will be the next president of the United States. And we'll reconvene and talk about that either later in the year or beginning of 2025. Thanks so much.
Awesome. Thanks, Lou.
Pleasure. This webinar was created in 2024 and is provided by Horizon Investments, LLC, and Tranquilli Financial Advisor, LLC, for educational use only. The opinions expressed herein are as of the date of the report and are subject to change without notice. Forward-looking statements cannot be guaranteed. This material should not be considered financial advice or an offer to sell any product. Horizon Investments and Tranquilli Financial Advisors reserve the right to modify their current investment strategies and techniques based on changing market dynamics or client needs. There is no guarantee that their assessments of investments will be accurate. The discussion, outlooks, and viewpoints featured are not intended to be investment advice and do not take into account specific client investment objectives. Before investing, an investor should consider his or her investment goals and risk comfort levels and consult with his or her investment advisor and tax professional. Information has been obtained from sources believed to be reliable, but its accuracy and completeness are not guaranteed. Past performance is no guarantee of future results. Risk Assist is not a guarantee against loss or declines in the value of your portfolio. It's an investment strategy that supplements a more traditional strategy by periodically investing assets in a portfolio of fixed income securities based on Horizon Investments' view of market conditions. Furthermore, when Risk Assist is deployed, whether partially or entirely, to mitigate risk for an account, the account will not be fully invested in its original strategy, and accordingly, during periods of strong market growth, the account may underperform accounts that do not have Risk Assist feature. While Risk Assist was designed with the goal of limiting drawdown, Horizon is not able to predict all market conditions and ensure that Risk Assist will always limit drawdown as designed. Accounts with Risk Assist are not fully protected against loss.